Welcome everyone to Foliko Live. I'm Travis Nixon, CEO of Cinerai, and I'm going to bring on with me Tyler Tucci. Tyler, thank you. Welcome.
Thanks for having me.
Of course. All right, today we're going to talk about some great things. We're going to start out with our weekly earnings roundup. Today, actually, we're talking about FedEx, Rite Aid, and CarMax. And then we're going to really get to some meat around FANG. So FANG has been really hurting for the past 6 months, rough times. Coming out of that, we're wondering, has FANG bottomed? And is now actually a good time to start taking a look at going back in? Over the past 5 years, a significant portion of the success of the stock market has come from just these 5 companies. If you haven't heard the acronym before, this is Facebook, which is now Meta, Amazon, Apple, Netflix, and Google, which is now Alphabet. I guess if 40% of the list of your companies is changing their names, it says something about the times, right, Tyler?
No, you're not kidding, and that's we have a great show today. Travis and I were talking about some of the FANG stuff beforehand. I think it's what we have is very cool. He's going to walk you through some of the more mathematical tools that we offer and deeper dives as it pertains to FANG. But before that, I just want to touch on a couple earnings of interest next week. We're kind of reaching the end of the interesting earnings. We're pretty much at the bottom of the order. On our coverage list, we have 3 of interest this week. We have FedEx, we have Rite Aid, and we have CarMax. I guess I'll just jump right in. We're pretty excited this week about Rite Aid. We have several models that don't speak to each other, so there is no cross-contamination. And this week we have significant upside in several models, one of them being the earnings-specific model, the other being our price-by-time model. We actually forecast 30% upside in the next 8 weeks, which we're making a call here. That means good earnings. As if you bring up the earnings factor, we're 3 days away from earnings here. And I think we have it would be reasonable to believe that price is going to follow earnings power higher. We've seen several cases this earnings season of that mean reversion, I guess should we say, especially when earnings power has ticked up and is leading. Additionally, as I mentioned, our other models see pretty significant upside in this name. So this is one that we will be watching very, very closely. It's one of our better ideas in terms of trading ideas that we generate off the platform, and in terms of conviction, because it's the bullishness is appearing across several models. So that's something we will definitely keep an eye on this week. We're looking for some upside, and then for it to sustain over the next 2 to 3 months. Those earnings, I believe, are due Wednesday. 2 other companies that we.
No, hang on. Before we move on from Rite Aid, though, I want to talk about this for just a second, because I think now, just a teaser, we are going to be jumping into healthcare full bore. I believe that's Wednesday, right, Tyler?
Yes.
But Rite Aid, I mean, look at this health score coming into mid-February. It had bottomed out for earnings power. I mean, it was bordering -1, which is as low as you can go in this score. And you come out and you see, I mean, they were really having major problems with profitability, closing stores, and just everything you wouldn't want to see. And yet since then, we've seen just a powerful recovery from that point until now. This week, we've got some more earnings coming out. I couldn't agree with you more, Tyler. I see some real strength. So beyond just the closing of stores that we're seeing, this PBM factor. Have you been reading or hearing about their PBM comeback and what they're doing with that, Tyler?
No, I haven't seen too much about that. I actually thought it was interesting, more as you mentioned healthcare. It's more of one of the risk off defensives. So that's more what I'm focusing on is as how it pertains to risk on, risk off, and the rest of our models. But I could see definitely cases. There's a lot of room for improvement. That's what basically earnings power is saying, and we're also saying that from that room for improvement, we have improved.
And so, and what I'm seeing too is as we look at some of these articles here, Rite Aid is really pushing on that PBM to show the market, look, don't just focus on us closing stores right now. Don't just focus on this short-term difficulty. We've got something going. I think the PBM route has worked out so well for CVS. Express Scripts was acquired by, who was it? Was that United Health Group? Who acquired Express Scripts? Anyway, I worked with Walmart in their pharmacy department for a little while, and the power of these PBMs jointly with a pharmaceutical outlet like Rite Aid, I think is not to be underestimated. I love this here. April, it was confirmed that there were buyout offers for them, $815 million. They rejected it. I think they're showing also confidence in themselves. So I like this company. I mean, clearly our models are also showing some strength there. Yeah, I think it's a strong pick. Go ahead, Tyler. Let's move on to the next one.
And just, to close the loop on that one, we have 40% upside on that one in 12 weeks. So, we're pretty bullish, obviously. And we're decently convicted about the path, from here. We have reason to believe earnings will be positive. The reaction will be positive, and we look for some follow through. So, we'll definitely keep you updated, and we'll, right or wrong, be back to discuss the why. Two other I'm just going to jump into really quick. We'll do FedEx first, just kind of the macro indicator, what does shipping look like? What do shipping volumes look like? Also probably will be somewhat descriptive of the current labor shortage situation insofar as, what does your backlog look like? What's your delivery on time percentage for lack of a smarter term? We see, mild bearishness. We think the stock price has potentially got a little bit ahead of itself, just if we're looking at it as a function of earnings power. But when you look at the more holistic picture, it's trying to improve there. The second half of the year, potentially the better supply chain stuff starts moving better, higher profitability. So that could be what the market is sniffing out that our earnings models are not. But it's one that we're somewhat cautious on. It's not, we didn't find anything exciting that would suggest to us that we're going to have some kind of blowout second half. The consumer remains strapped. We continue to hammer that point. Our consumer discretionary forecasts are pretty ho-hum. I think we're somewhat constructive on Lulu, but pretty much the rest of the sector we've been pretty bearish on. So
Tyler, a quick question for you on this one. I mean, FedEx end of 2022, we're looking at over 260. It has gone down, but it's also repaired significantly since beginning April. I mean, so why is FedEx spared a lot of bloodshed that's been seen in the market? What is that? A drop of $25 from $260? That's not a significant drop. Is this a company that has strength in the midst of what is otherwise a rough market, or is this something that it hasn't hit yet?
Well, I mean, that's basically, it's a bet on the second half of the year. But I mean, it does point to the fact that, Dow stocks, commodity stocks, things like that have just, flat out outperformed tech. That doesn't mean they've gone up. It just means they've gone down way less. And FedEx didn't get that kind of bubbly look that, say, Home Depot got, which ran up to, I believe, as high as 450 or 460 before they knocked it over. So, there is an argument that if you don't pull the rubber band back as far, it doesn't need to snap as much. We see that nice pop in the price with a little curl in earnings power. So that's, something we definitely will keep an eye on. But in terms of, would you look to enter some sort of bullish or bearish structure on that? No, probably not. It is. The whole picture is improving there if you look across all 6 health factors, but it's not one that we are going to extrapolate some wild call from. It's one to be watched. It's slowly improving. Travis is going to talk to you in a little bit about when we kind of see tech stocks bottoming, so that could kind of play into when we see more of a general bottom across risk assets. But nothing horribly exciting here, but some things definitely to keep an eye
on. And this is always interesting to me, because between now and Thursday, they're reporting Thursday after market close, right?
I believe, yes, 4 days, I think, till earnings.
Between now and Thursday, we could see a sudden and serious spike here in this earnings power, and that would indicate something, right? Like, and let's remember also, where are these earnings power, or where's this health score coming from? This is coming from a lot of people talking about FedEx in certain contexts, insiders, outsiders coming in, giving their views, customers coming in, giving their perspectives of FedEx. Folks talking about the supply chain and costs of FedEx, and all this gets in an intelligent way through AI mixed into a fully baked pie, which we call earnings power. And as this earnings power, I mean, look at last week. This is worrying to me. You see something from the 5th down to the 11th, a sudden spike downward. Let's see if we can hone in on some of the articles that were driving that. So FedEx coming in with a lot of these issues. Let's see if we can hone in on some negative earnings power reports. Let's see. If we go specifically here to some negative issues. But it's that kind of movement that makes you hesitate a little bit, especially, I mean, you're seeing right in line with that earnings power, that stock price taking a dip. As it recovers, I think this is something, Tyler, we're going to want to give an update on Wednesday when we're broadcasting again. Let's see here, online shoppers. Here we go. Elements like this coming in, and to this, I think you're seeing problems with supply chain. You're seeing problems there, and of course, FedEx is going to get entangled up in all of those issues as supply chain issues continue to be difficult. Their costs are obviously increasing in the midst of increasing energy prices, everything like that. All right, Tyler, last thoughts, or should we move on to the next one?
No, we're just one final thing. We're going to look for rate of change on the earnings power coming into earnings. As much as the outright level is important to us, the rate of change is just as important, because that starts to tell us something's changing. That's when you potentially see those violent moves up or down, when you see more or a higher rate of change in the earnings power indicator, as we've somewhat found.
Yeah.
And so we'll just close it out. We're going to look at CarMax. I think CarMax is interesting because one of the pieces of the inflation picture had been how crazy used car prices got. Everyone had a story about for once we finally all beat the car dealers, and they had to give us checks for once. So it'll be very interesting to see. There are several car stocks. I mean, Carvana's absolutely got destroyed. That's more of its own issues. But in general, used car prices and things like that are going to be meaningful in terms of painting a macro picture. So when we take a look at KMX here, we're gonna. We like I wrote recently, I wish we had better news. I wish that we were able to say that we have an incredibly bearish view on this, which would potentially mean that the worst of some of the components of inflation are behind us. But it's not, we're not quite there yet, unfortunately, is pretty much what I've seen. Travis, I'm going to
my
bring
internet here is struggling. There we go. Yeah, streaming 2 screens models going on. My internet's starting to hiccup a little bit, but yeah, we've got CarMax up now.
And we do see it sliding lower, but it's not all that shocking of a forecast. It's not like Rite Aid where we're sticking our feet in the ground and we're making a call. This is more like, not so good. Expect a slow bleed lower, but there are some things that are certainly at least trying to turn around as he's going to show you, systemic and some of the competition and earnings power stuff are trying to have a positive rate of change, which would potentially be signs for us to start taking a look. But this is another wait and see one. The call and the numbers will be very, very meaningful in terms of kind of just, as I mentioned, painting the macro picture. How did the last quarter, go in this sector? We'd like to see lower prices, which actually, our model is not necessarily supporting. It's systemic turning up. Maybe expect some higher car prices in the next 3 to 6 months, which would kind of be pretty annoying for the Fed.
Tyler, on this one, how much is interest rates going to be affecting the back half of the year for CarMax? And second, do you think a stock market shock, like a recession, or not stock market shock, a recession has already been priced into the market? And if not, how does that affect CarMax?
Well, I'm gonna tee you right up to walk into FANG here, and the answer is no, not really. We are significantly off highs in some names, but in 2000, a lot of names doubled 4 or 5 times on the way to zero. So all that does is point to the fact that in bear markets, prices can squeeze very hard in either direction. So we're gonna show you some work now that suggests that no, the recession's not fully priced. We're going to get there. We're going to get there sooner rather than later, which is good news. But I'm going to turn it over to you now. But the spoiler is we definitely see a bit more pain. He's going to let you know how much.
Yeah, well, I don't think it's over yet. So weekly earnings roundup. Overall, I mean, we've been waiting to see really earnings fall, right? And is this? What we have here is what I heard from you was 2 tepid and actually 1 really positive from Rite Aid. What do you think about as we come up the next couple months? I mean, July is going to be quite the month, isn't it? A lot of releases coming out. The week overall, what would be your reaction to where the market's at right now?
I mean, the summer July 4th weekend has always, traditionally been very strong. We're going into tech earnings that has traditionally kind of carried over and given us a boost. But none of those things are to our advantage now. If you told me that the July 4th coming weekend or upcoming weekend means less liquidity, that's a nightmare. It was good news when the market was running up, because that meant we could run higher prices. But with the way things are trading, reducing liquidity significantly is not a bullish characteristic at the moment. So it's interesting to see that we are still this bearish this time of year. This has been a pretty good time of year to be long, especially tech stocks. We're about 30 days out from the next earnings. So we do have some interesting things to show you as it pertains to, for example, Apple earnings and a couple other things, but it doesn't look like we're done yet. It looks like we need to take a bit more pain, and we're kind of seeing that across models. It's not just one model that's telling us bearish. It's pretty much everywhere we look, it's bearish. And I keep wanting to make the bottom call. Being bearish into lows is terrible for business. You look completely, like such a fool. So even though I would like to be bullish, there's just nothing here to be bullish on yet. If you want to be bullish on something, maybe get long some Rite Aid this week. But aside from that, I'm going to let you start showing, your analysis, which, as I mentioned to you, is there's nobody else doing this right now. There's nobody who is going to show you, their code, explain the math and the data science that were done at this level to anybody. So I'm just going to let you go right into it, and I'll just kind of translate and ask questions over here that I think people will want to hear.
Sounds good. Yeah. So let's start talking about FAANG. Right? Has FAANG bottomed yet? I think that's a persistent question. Roll back to the beginning of May, and I think a lot of people were wondering just that. And we've seen a lot of these companies that were so strong for so many years dropping what 70, 60, 50%. It was really a bloodbath, especially between end of February out to May. Then there was a bubble, and that bubble, Tyler, I think that bubble really hurt a lot of folks because everyone's wondering, are we out of the bear market? Are we going to be able to avoid the recession?
You talking about the bear market rally into early June?
Yes.
Yeah. Okay. I just want. Yeah. Okay. Yes. There was. Yes. That big leg up that everyone thought we were saved.
Sorry, not bubble, rally. Yes. I kept hearing so many folks going out with analysis saying, oh, the Fed has finally threaded the needle. They finally figured it out. They're probably not even going to do 50 basis points up this next meeting. Clearly everything's good. And then that CPI report came out, 8.6%, right? And that just crashed everything. And now everyone's still stuck with the same question. When is FAANG bottoming? Because, after last week being, what was it, the second worst week we've had yet this year?
An ugly one for sure.
Yeah. So we've been whipping up some new analysis to wonder that exact question. We have these health scores, right? And once again, I want to recap what these are. We're pulling together millions of news articles on over 1,000 companies every day. Our AI engines are reading those news articles, and they're comparing not just a company with a company, but a company with itself, or even a news outlet with itself. And I'll give you an example. Suppose you have a news outlet like MarketWatch. MarketWatch releases an article about Amazon, and they're saying, oh, Amazon is great. And they've been pro Amazon for years, right? And then all of a sudden, the next day, they give an article that's really super negative about Amazon. Well, our algorithms are going to pick up on that and say, well, this outlet that's usually pretty positive is now suddenly negative. And they're negative in specific ways in how they treat their employees, or they're negative in specific ways in what their EPS upcoming is going to look like, right? We take note of that. And that gives us these very powerful 6 health scores to be able to monitor every day. But there's a lingering question there. And the question is, once you have these health scores, how do I then interpret them and turn this raw data into an actual trading strategy? And so my thought in the past few days was, well, how can we learn from experience in a way that doesn't take years to learn? How can I look back and say, well, all right, Amazon has 6 different health scores. And actually, let me just even pull up Amazon as an example here of what I'm talking about. So let me bring this over to Amazon. And my internet's been funky today. I think it has something to do with streaming. But as I get used to that process. All right. So Amazon.com, we have these 6 health scores, and you can see trending downward. Tyler, I am getting a little bit of an echo from you, buddy. As we're trending downward on these health scores, and then all of a sudden we see a spike, and we're seeing a spike in management while at the same time systemic is down, reputation is staying down. So how do we interpret this? Does this mean that there's necessarily a purchasing opportunity here that I can start to exercise? Especially, look, ESG and management trending up. Is that something I can take advantage of? So I wanted to take a look and say, where have we seen this before? And there's a few different ways to look at this. I can look at what the numbers actually are today. The best way that I can get that view is actually looking at the homepage for this company's profile. And I can see competition, really negative, earnings power, management. I'm most negative in reputation, right? So now I have the opportunity to come in, do some deep dive, some analysis for why is the reputation score so low. But it's not just the score in a static state. It's also, where is this score coming from, right? And I can tell you over the past week, there's been a pretty significant change in Amazon's management score, right? Over the past 10 weeks, there's been, and I can look at this through some smoothing there, take the rolling 10-week factor, and I can tell you exactly what this has looked like. Well, can I compare this with Amazon's history? And that's exactly what I'm going to show you next. So I'm going to start sharing a different screen. Let me pull you over to this window here. So I'm showing you here my Visual Studio Code environment. I like to code in Python, so that's what you're going to see here. And here I've worked up something where we can use something called Euclidean distance. Now, a lot of data scientists or statisticians will be familiar with that, but for anyone that's not deep into statistics, Euclidean distance is a nice way for us to measure how far apart 2 points are. So if you have point A and point B, you can draw a straight line between them and measure the distance, right? The shortest distance between 2 points is obviously going to be a straight line between them, right? But what happens when you have more than just 2 dimensions, this height and this width, in order to compare? You also have, like we have today, 6 different health scores, the 1-week history of those health scores. You have the 10-week history of those health scores. All together, that comes out with 18 different data points. How do you draw a straight line between 18 different data points? Statistically, it's actually fairly simple, but us as humans, we wouldn't be able to just do it on our own. And that's what we're going to do today. We're going to come out and enter in Amazon. Now, in the future, once I put all this into production, this is going to be a lot easier to do, just one line of code. But for today, let's take a look at Amazon and how they're looking. Now, this is going to take about 10 seconds to run. But after this goes, what we're going to do is get a picture over the next 30 days, 6 months, 1 year, 2 year, 4 years. Every time we've seen a company looking the way that it does, Amazon does right now, what have we seen in the past? And what I'm doing is I'm actually taking the 1,000 nearest data point from Amazon today, and I'm saying what happened to them in the stock market on those time horizons going forward. So let's take a look at Amazon. And what we're seeing here is, let's actually see if we can even zoom in a little bit. On this first data point, in the nearest term, we're seeing on average, in the 1,000 times that we've seen situations similar to this, we've seen Amazon go down between 3.3 and, or sorry, 0.3% and 0.4%. Remember, that's a very near time horizon. So that's actually a significant move to the downside for Amazon anytime a company has had health scores similar to this. Now, there's a few ways that we are looking at this. So it's 3 different models coming together. One of them is, what if I take into account the 1-week trajectory of Amazon? What if I take into account the 10-week trajectory? Or what if I throw it all into the stew and compare it all together? It turns out those 3 different ways of looking at things tend to agree with each other pretty well. But it gives us a view not only of Amazon in the next short while, but what about over the next several years? And actually, I'm not showing it here. I can. If we just extend this out to here, we're looking at this all the way out to 2025, right? So several year view of what's going on. I wanted to hone in and be able to look at the near term so that we can answer that core question of why you may have tuned in the first place. Has FAANG bottomed? Well, we're taking a look at Amazon right here. There's another way that we can look at this that's actually going to be stronger, because look, you also have to compare this to the fact that we've seen the stock market in a lot of different situations. So the stock market has just generally been a very strong place to invest for the past decade, at least, excepting things like 2018, the first couple months of 2020. Generally, you've had very favorable conditions for equities, especially FANG. So how do we normalize and take those market bullishness effects out and just look at the company? And this is where, all right, throw all the other statistics out. This is where we're going to get a view of generally what is the strength of Amazon over the coming months. And the key point here is when these lines meet up with this red 0 line here, that's where you see a true bottoming. And so in Amazon itself, where we're seeing some real problems is in the near term, going up to at least August, mid-August, Amazon's really still not looking strong from a health score perspective. We're not actually seeing a bottoming out of Amazon until at least this December, maybe into the new year, at which point we are seeing a lot more strength. So if we pull this factor back out, if you go past the new year of January 2023, actually really strong going into July 2023 and thereafter, probably some fantastic recoveries. What these models are saying, and we are, of course, going to be updating this, you're always getting new data. Our AI engines are going to read new articles and synthesize how the market is evolving and changing. So, of course, tune back in for updates as this changes. And Tyler, we are still getting a little bit from your mic of background echo.
How we doing?
Let me test it out now. Yep. I think that's working out for us. And so that's what we're seeing. Amazon. Thoughts on this, Tyler? Before I take us to our next FANG, Amazon. I'm really not seeing a case for bullishness. I mean, take a look at another time when we were doubting Amazon. Take a look back in April of 2020, April 1st, 2020. And while I'm pulling this up, go ahead and feel free to comment on what you see here, Tyler.
So two things, just one technical point that I want to point out to, we're not all data scientists, myself included. So it's important to think on this graph below, think of it as these numbers. Think of it as binary. If it's over 0, you're long. If it's under 0, you're short, underweight, bearish, whatever. It's not that that's not a 12% drawdown. That's just a scale to show basically, the degree of negativeness as it pursues the flip to bullishness. So I just wanted to point that out.
And quick question for you, Tyler. Would a good interpretation of this be similar to how we look at the VIX? And there's certain thresholds and lines where it says something about the market. It's not directly interpretable for how you would want to go forward, but if it's at a certain threshold, it changes your view of what's going to be happening with the future of the market. Is that similar?
Well, I don't know in terms of VIX, but in terms of a risk metric, I mean, we definitely are modeling for how risky this is. We say over the next month, quite risky, but we say, by call it, August, September, less risky, still risky on an absolute basis, but less risky. So it's, in my mind, it's a way to think about degree of bearishness or degree of bullishness.
Right.
Obviously the bottom is 0% bullish all the way up to the top. And it's interesting because as we continue to go through, as we've looked at semiconductors, we've looked at some of the bubbly, growthy, techie names. Now we're looking at FANG. It's all kind of coming to a, check back in October-ish if you want to get long, is how I would categorize my review of everything the model puts. From a single name company basis, I gross it up to a sector, gross it up to kind of start to form a macro view. And when you go sector by sector, the risk on growth, growth on no recession stocks, for lack of a more intelligent term, all looking like kind of August, September, October bottom context. So, that's interesting. We'll continue to find defensive longs like hopefully Rite Aid and things like that. But on a bigger picture, this is just another point for the case that we're just not quite there yet.
Yeah, absolutely. Well, and so let's take a look in April 2020. Look, looking back, everyone's like, oh yeah, April 2020, you can invest in anything and make money. No, there was a lot of uncertainty. Like people did not know what was going to be happening with COVID, with shutdowns, lockdowns, everything like that. And let me show you what this same graph would have looked like April 2020. So you come in April 2020 and disregard, again, this is not a model in production. I'm showing everything pre-production here. So disregard the dates on the bottom. This first date is going to be April 2020 for us today. But in essence, what we have here is a short-term difficulty for Amazon leading into after about a month. That's where it really heals and everything looks fantastic for Amazon, like really looking bullish there in the indicators. And if you pull up, let's pull up the stock chart here, come into Amazon. telling you, Tyler, my internet today.
Your system's doing too much thinking over there.
Too much. So, let's see if I've got. No. All right. As soon as Yahoo Finance starts cooperating, we can pull this up. But in the meantime, there we go. Amazing. Try out a different browser.
If that doesn't work, we can just jump ahead and show them Apple too.
Yep.
We can get that to load.
Yep, let's go ahead and do that. So Leia, let's jump to Apple. Keep in mind what we just showed for Amazon. Change our date horizon. I gotta tell you, Tyler, doing live is different. It feels, doesn't it?
Yes. We're definitely we're doing our best here. We're both traditionally content people, and we think this is important enough to get behind the camera and try to get this out in front of you in our words. So we're learning one episode at a time, I think.
And there's something authentic that comes out around some of these tech errors sometimes, internet not being good enough and stuff like that. There's things you can't plan for. It's how you get out and you are authentic. But coming into Apple, it's actually a similar story. Around the end of the year, let's bring our backtrack back to 6 so that we're looking at it similar to Amazon. We are seeing some extreme bearishness for this company in the near term. Look, I think Apple, generally, my impression is that the market has not really corrected Apple down like it has with the rest of FAANG. And Apple, doing some research into this earlier today, I think there's some real concerns, especially around its App Store. I think App Store profitability going down for May, the real red strike against it. I think Morgan Stanley, it is put out a report about Apple and their App Store having some real troubles. And they've been able to avoid a lot of this, I would say, ending of COVID, work from home type of stocks. So a lot of those work from home stocks that were supplying devices, making it easier and better to work from home, they were doing great during COVID. But once COVID lockdowns ended, a lot of those stocks saw some slippage. Apple was able to avoid that by saying, hey, look, no, our App Store is actually growing fantastically well, even though lockdowns are ending. May was really a strike against that narrative. And I think coming forward into earnings, I think it's next month, right, Tyler?
Yeah, we're about 30 days away.
Yep. We're looking at still not a lot of reason to be hopeful for Apple's earnings bringing us out of a potential recession, certainly, and coming out, reaching that bottom right around mid-November this year. And that's generally the effect that we're seeing around all of FAANG. I'll start pulling up all these reports and just jump into the chase here. But at the end of the day, I think, of course, we're going to reassess here in a couple months. But I'm not seeing much of a reason to really be bullish about these companies, at least this calendar year. Netflix is interesting because we see in the very, very near term some real difficulties, but actually some healing. If you look at Netflix coming in July, actually, I think there's more reason for strength there than there would be in, say, Apple, especially at least according to this data here. I think it's interesting that their 10-week is more bearish than their most recent, and to me, that shows and some indications of a company that's actually improving in their health scores. With the positive release of Stranger Things, I actually think that there could be some reason why Netflix is not as damaged over the coming month.
And that's partially because of where it came from. I mean, we just beat the ever-loving heck out of that thing for 2 earnings in a row and all the meantime in between time too. So I think that idea kind of points to the idea that maybe Apple and some of the less damaged names will lead the next leg lower. So for example, we obviously wouldn't put this trade on, but long Netflix, short Apple, we think would outperform, Apple is going to outperform on the downside. So that, is potentially an interesting, somewhat bearish expression, just thinking out loud here, but that's kind of how we're looking at it, where, most of the damage to Netflix has already been done. There's a considerable bit more tuning up that we could do to Apple. I think we have it on a 12-week time horizon. We have it cracking below 100. So that would have a very, very interesting knock on for the rest of the market. It would be, stranger things have certainly happened, but in a situation where Apple is hurtling down towards 100 and ultimately maybe 96 or so, it's a pretty decent weighting in a lot of indices and ETFs and things like that. So it's very difficult to hold the market up when Apple is in trouble. And we think it's, in a good bit of trouble. We don't just see 5 to 10 here. We see a pretty big draw. And again, even if you're not of the short, the short selling, put buying bias, what this means for your longer term portfolio is you can still wait. That doesn't mean there won't be some squeezes higher that, you get some buyer's remorse, but, ultimately those we think, will get reversed out, in spades actually. Earnings power did recover, but the rest of this, not so great. So as we get into earnings week, if earnings power is still where it is, we'll have some thoughts and a conversation around that. But this is definitely one to watch for the next 30 days going into earnings. We think it's in trouble.
Well, and its earnings power has stayed mostly positive. A little bit of downside here in April, but it stayed mostly positive for all of 2022. I think that is really a strong explanation to why Apple has floated above a lot of other FANG. It's their continued ability to produce strong numbers in the midst of all these headwinds. The question is that going to hold up? And really, this next earnings report is going to be the big factor to determine what Apple's going to look like the back half of the year. I think that is going to be a key one to watch. Of course, week of Apple earnings, we're going to need to do a deep dive on that, Tyler, and really go in detail why we think what we think, where it's going to go from there, everything like that. Well, maybe even a special episode dedicated to that.
We'll be in the heart of the order in terms of earnings season, so we'll have plenty of names to cover during that specific time. That's right where all the magic happens or not. So we'll definitely be very, very in front of everyone with what we have, if we see anything that's potentially tradable or interesting or outlying. But at the moment, not so good, if I had to say in one sentence.
Yeah. Well, speaking of not so good, a company that I've loved their products for a long time, but I'm not seeing great things, at least this calendar year, for Meta, formerly Facebook, right? Meta, pretty much across the board, we do see some healing there after August, September timeframe. But they're taking longer, certainly dragging their feet as compared to the rest of FANG. We're not seeing that market equalization or bottoming out till beginning February 2023. That's a couple months delayed past the rest of FANG, and I think that's an interesting indicator.
And yes, and we'll talk about this in the next one, kind of confirming the same story. Meta, unlike Apple, Apple hasn't really sold off. It's sold off some, but Meta's been blasted. More like Netflix than Apple. And if we're going to have a recession, a company that generates the lion's share of its revenue from ads, both in the case of Google and Meta.
And on the screen, we'll be seeing this is going to be Google right here, Alphabet.
So that looks like, if I was just reacting to it, that looks like like a mighty squeeze higher. Okay, so that's our favorite. That you know, that would actually argue that the recession is somewhat priced in, because I think, you know, Google and Meta's stock price are the most impacted by where we are in the, you know, in the business cycle. People are always going to, you know, buy iPhones and, you know, spend money at the App Store on credit and, you know, things like this. So that's not as big of a concern for me as, you know, if nobody's buying anything, nobody's trying to sell anything either, right? You know.
So Alphabet, though, I mean, our models are predicting tough times for the next 12 weeks. And certainly here, the health score view shows near term, at least the next week or so, some troubles. But yeah, the health factors seem quite strong for Alphabet.
Starting to roll over, but you know, that would make sense given, you know, some of the headwinds.
Yeah.
But you know, maybe it's able to withstand a bit better. You know, Apple is our biggest downside. If we were going to pick one, I think we'd be short Apple, and if you made us be long one, it might be Netflix. You know, but these other two, you know, Meta for me is a do not touch, and I think that's kind of corroborated by what we have here. I mean, that's going to take, you know, it's going to take Metaverse 2.0, or, you know, something for people to really get excited about it again. You know, that stock's been a hedge fund darling for quite some time. So you also have that added, I guess, negative premium, you know, in the stock price now that it's not, you know, as loved and held by, you know, as high a percentage of funds. You know, there was a period there where FANG was basically thought as like, you know, slightly riskier than treasuries. You know, your money market cash would go into that stuff, and you know, that's I think, you know, pretty much behind us for the most part, at least for the better part of this year. But
Until we can find the next FANG.
right, and that's what we talk about is, out of this turn there will be new leadership, and that is, you know, between now and October, what Travis and I will be doing is trying to figure out, you know, where that's going to be, what's turning up, what is showing outlying strength against, you know, what is still a pretty bleak backdrop.
Not solar, not so far.
No.
What is going on? So solar, gas, energy. Holy hell! What is going on there, Tyler? That is something that is fascinating me. How much we have come back to a fossil fuel view in this country and in the world more generally. I think a lot of people thought and hoped that we were on economy 2.0. And economy 2.0 was all about your digital self and your solar cells, and it didn't require the dirty, messy, go to work in an office, you know, polluting with your polluting car and everything. It didn't require a lot of these things. Where is the energy market headed? I think that is the question of tomorrow. But for today, we've talked about FANG. Tyler, last thoughts. How do we summarize? How do we come together? We've looked at now together 5 new companies in a new lens, new set of models looking at the data. I think 4 of the 5, we've seen real bearishness in this health score factor outlook. Alphabet was a surprise for me. I didn't think to see such strength coming out of that, but there you go. And it's interesting that 2 companies with very similar business models, both relying on ad revenue, Meta versus Alphabet, are seeing such extreme different results. I think that'll be an interesting entanglement to see what happens going forward. I will say, I think Google wins on the devices front, given the strength of their mobile line, versus I don't think VR is there yet. As much as Zuckerberg is teasing all these extra headsets, which look awesome. I'm a huge fan of the Quest 2, but I just don't think that the metaverse is ready to cash out yet. And in an era where iOS has already chopped off a lot of their ad revenue, and Android is talking about doing the same in the next couple of years, to me, one is on a melting iceberg, and the other one is on a temporary setback before it regains dominance. So I that's where I see the difference happening there. Tyler, last thoughts on the FANG debate.
Yeah, I mean, just, again, I'm kind of getting a little bummed out listening to me, right? I wish I could tell you just, drawdown's done, get long, prepare to party, but that's just not what we're seeing. We're looking for it. I promise you, we spend, tons of time this, a week, the weekends, really looking for, how might we be wrong, right? And thus far we really can't find it. We see pretty significant downside, pretty outsized downside. Stay away from FANG stocks for now, and we'll talk to you this fall.
Absolutely. All right, everyone. Thank you very much for joining Foliko Live. We're going to be back tomorrow talking about energy. Join us. We're going to be going before the market opens tomorrow, right, Tyler?
Yes, we will.
8:30 Eastern, 7:30 Central.
Yep.
Join us here on our channel. Thank you, everyone, and we'll see you soon.